Welcome in. We got a great episode today with Mr. Brad Johnson of Vintage Capital or Vintage Funds. Brad is the co-founder and CIO of Vintage Capital. He has over 20 years of experience in mobile home park investments and closed over $3.3 billion with a B in real estate acquisitions. He previously was on Wall Street and worked in private equity and decided to take all of those learning lessons and bet on himself. He was ultimately, handcuffed with the golden handcuffs, big bonuses, and was only getting to spend quality time with his son and his family in the evenings, which was few and far between, and therefore decided that real estate and all of his experience and skills were going to need to be leveraged, and the vehicle that he was really going to unlock the life that he wanted. And the journey that he went on was pretty amazing, which you're going to hear about in today's episode. More importantly, you're going to get to learn all of the ins and outs of how a top mobile home park investor and operator does things, from how they find them to structuring them to capitalizing them to operating them, all the do's and don'ts. So if you're somebody that is interested in mobile home parks, and more importantly, I'm not a mobile home park investor. Well, I'm closing on a mobile home park here in the next week, a small one. But again, not my main asset class. But as an investor, as a real estate investor, whether you are investing in mobile home parks or other asset classes in the real estate industry, there's always such amazing insights and nuggets to be learned from people who've got the experience and have been in and out of so many different deals and seen so many different things that you can learn from and pick and pull from your journey. And there's a lot of those golden nuggets dropped in today's episode. So without further ado, I hope you enjoy. Let's dive in with Mr. Brad Johnson. Mr. Brad Johnson, welcome into the show.
Thanks for having me, Matt.
So take us back to the beginning. How did you first get into real estate? I know we're going to, cover your journey and building your mobile home park empire. But I'm always curious on kind of that origination, that inception story of like when your mind allowed you to start, physically pursuing a space and a career and a path forward in real estate.
Sure. Yeah, I started off just buying, single family homes with a couple of buddies. We had a business that was kicking off cash flow. We were entrepreneurs, and we stupidly thought, well, let's diversify by market. And so we bought one rental in Tennessee, Nashville, one in Palm Springs, one in Austin, Texas, and a couple more. We thought we'd go to places that were fun and enjoy the nightlife, and that was our entire thesis. And of course, that's not a very good way to run a portfolio. And it worked out well, thankfully, but it kind of was really the catalyst for me getting excited about real estate, because I just understood it. And I loved the idea of the regular recurring cash flow coming in with some tax benefits. And so that was really the jumping off point for me to start thinking about it. And then I went into more of an institutional real estate career. So working in private equity, working on large deals for family offices, real estate investment banking. And then when I was just kind of working on a deal for a large portfolio of loans, I kept coming across manufactured housing included in these portfolios, and noticed that they had the highest yield and yet the lowest default rates, which those two things usually don't go together, right? So I would ask these lenders why they kept throwing in, mobile home parks into these loan pools. And they said, well, they wanted to get the higher yield, the higher cash flow, and they wanted to reduce the risk of the portfolio. And I was like, okay, light bulb moment, like that shouldn't exist. So let's dig into that.
Very cool. So that was kind of the catalyst that led you into the mobile home park space. And at that time, you were still, it sounds like, working in a shop or working.
I was investment banking, so I was working insane hours. I just had my first kid in San Francisco, and literally every picture of him on my phone I'd show people was of him being asleep, because Daddy was always gone to work in the morning and coming home late. And I was just like, this is not sustainable. I want to go do something for myself and build a company and be able to make my own hours and see my son, when I want to. And so that was, I figured, probably the best time to do it, because the bonuses were only going to get bigger, right? The handcuffs were going to get tighter. So we made the leap and left San Francisco without that upcoming bonus. So it was kind of a dumb financial move. But I just knew that if I didn't do it then, I probably would never do it.
Good for you. I know that is not always. It's easier said than done, but obviously your priorities in your family was more important than the paycheck, as you had noted. But of course, knowing that you're a savvy, smart dude, I'm assuming you had some type of transition plan, some building blocks or stepping stones that were
You're
leading
giving
you
me way
there,
too much credit.
or
Yeah,
maybe you
no,
didn't. Right?
I
I
had
don't know.
nothing. I literally had nothing. I had some savings. And so make sure we could afford, cover the rent for a couple years. And that was really the thing. My thing was like, as long as you have a couple year runway,
Yeah.
you can always bounce back. I think people they overestimate the risk, right? If you're young, you have a track record in a professional career, you have a network. If it doesn't work out, you can always go back to work. You can always kind of make things, work out. But if you don't make that leap eventually, and it's something you've always wanted to do, like I said, it just gets harder and harder. So that was the bigger risk in my view.
So what did the first mobile home park deal look like, or what did the first deal look like outside of
Yeah.
the career, and,
Yeah.
and how were you thinking about that deal? How'd you approach it? How'd you structure? Where'd you find it? What did that
Yeah.
first one
No,
look
I'm
like?
still bitter about it. The first one did not work out. The first one, and I partnered with somebody that had boots on the ground experience. Uh, and I was more of the finance guy. I was going to be the engine of growth, and that was my pitch. And the wives met, and we decided to do a partnership. And the first deal that we found, I just cold called a broker in this market that we liked, and it was a deal where they tried to expand, and the owner, which was an older gentleman, kind of got out over his skis in terms of how much capital it was going to take. And so it was like a half done project. Half of the park was existing, plenty of cash flow, and then half of it was just raw lots. And anyways, so we couldn't get a lender. This was in 2013. We couldn't get a lender, so we called 100 different lenders, and finally somebody said yes. And we're about, I don't know, 3 weeks from closing, and the lender says, "Hey, look, we're going to need 2 more months because whatever, we just need to check some other things, get some paperwork in order. The presidents went on a trip, and when you're working with a local credit union, it's literally one person makes the decision sometimes, unlike a giant, Wall Street bank." And so I thought, well, I'll just ask the seller, "Hey, we just need an extension. We'll put up more money." And he said, "Nope, I got a higher offer. We're going to cancel the contract." So that was kind of a painful first, attempt at real estate because, you're out due diligence costs, you're out your
Yeah.
time and effort, of course. But thankfully, the next one worked out. So, I always warn people that, plan on the first year not going as smoothly as you think it might.
Yeah, I remember my first mentor told me deals are like buses. There's always another one coming right around the corner.
Yeah.
Right? When you're first starting out, like you hang on every deal. Every lead is like, end all be all. But when you really kind of, get some experience and you understand what goes into getting a deal across the finish line, right? It's a lot of work, a lot of dots that need to connect it, a lot of things that need to go right, a lot of
It's a
things
ton.
that you got to mitigate along the way in order for all of the stars to align on a deal. And so I love that you said your first deal, it actually wasn't a deal, right? And that was a good learning lesson. So what kind of landed you that one deal that you got across the finish line on the first one in the portfolio?
Well, what helped is it was seller financing, which is pretty common in our world here in mobile home park land. Because you're working with mom and pop sellers oftentimes, and sometimes they've owned the park for 30, 50 years almost, right? That maybe their dad developed it. And they generally don't love paying the taxes on sale. They don't know what to do with it. So thankfully we found a seller that wanted to carry the note. He's like, "Look, I know this asset better than anybody else. I know the cash flows are regular and recurring. I'm happy to carry a note for 60%. You come with 40 equity." And so that made the whole process smoother, right? Because when you're starting out, you're trying to triangulate three things, right? The deal, due diligence, the equity, and then the debt. And those things lining up when you don't have a ton of experience or resources, very tricky, as we've kind of talked about here. But when you kind of remove one of those things from the equation, the seller financing being in place really helps on a first deal. And it also makes the due diligence easier because you actually know that the seller really isn't trying to pull one over on you
They're
because he's
aligned
going to
with
be
you.
stuck with a loan. And if he does, guess what? You can stop making the mortgage payment if there is something that's horribly off that he's lied to you on. So that solves a lot of problems on our first deal. And luckily, that was the one that we got over the finish line first.
I love that. I love
Yeah.
that. And I'm sure there were many learning lessons. I love that you brought that up though on the seller finance side of things. I don't hear a lot of people talk about the alignment of
Oh, yeah.
a seller being the bank and really being a partner in the deal with you.
That's exactly how you should think about it. They are an LP in your deal, effectively, is how I think about it. Not even just a straight lender, because really they're foregoing a big paycheck,
Right.
And because they know the asset better than anybody else, you just feel a lot more better. You feel a lot better at what you're looking at when you look at the diligence files.
Yeah. Looking back on that deal, what did you learn going through that process as kind of a new mobile home park investor? I'm assuming you had proximity and exposure to a lot of deals, a lot of underwriting. You kind of knew just by being aligned with the big boys and girls of institutional capital, family offices, private equity. You probably saw a lot of horror stories and a lot of ways that they either solved those problems or mitigated those risks. But what were some of the things that you learned when you were in the driver's seat of your own deal?
Yeah, it was kind of funny because I went from my last deal at Eastfield Secured, which was the real estate investment bank, was $1 billion large development with joint venture with a giant sovereign wealth fund. It actually is Salesforce Tower, right?
Oh, okay.
So we helped make that deal possible. I went from that to a $1 million deal that was my own mobile home park in Kansas. So I literally couldn't have been at two different sides of the spectrum. But what I did learn about the first one was, well, really, I moved quickly, right? So when I was starting underwriting deals for that first year, I would do the whole, 5-tab financial model. I would obsess about the IRR. I would obsess about every little piece of this deal. And then I would dutifully submit my LOI on our letterhead. And I would just kind of go through the motions that I knew from the institutional world,
Yeah.
and thought that the timing was also going to be like that. And so many times I'd call the broker and be like, "So did you get my LOI, or what do you think? What did the seller think about the offer?" And be like, "Oh, he took the first one that came in 2 weeks ago on the back of a napkin offer that the guy got." So I learned pretty quickly that it's a different world, and you have to, when you see something that fits all your boxes, right? You got to move fast, right? And get the purchase contract out that same day is what I eventually got to. There was no more model, there was no more LOI. Like, I could do all those things with the lender after the fact, but
Yeah.
tying up the deal, getting control of the deal is paramount.
Yeah. Yeah. The big boys and girls move and operate a little bit differently than, let's say, the mom and pop tier of commercial real estate investors. And
Yeah.
and there's pros and cons to that, right? I mean, there's nuances that if you understand how to navigate those conversations, those personalities, those
Yeah.
types of deals, that can actually be an edge that can help you get the deal done.
100%. I've sat across many sellers in their living room or dinner table, just trying to make a handshake deal, because you're not working with a giant private equity firm in this space. We are getting there. Eventually, you'll just be just like apartments, where you'll be buying and selling from other professional investors. But right now, there's still plenty of consolidation to happen in the industry. And when you're dealing with a seller that they just want to feel good about the transaction, they want to make sure you're not going to come in next day and triple the rents, even if you could, right? They want to make sure that you're a real person that knows what they're doing in this space and is going to stand by their word. They don't want to be retraded. They just don't want minimal hassles.
Yeah.
So yeah, that is definitely an edge if you can build relationships, build trust with the sellers.
Yeah, especially with the big, institutional level investors. When you hear people say there's no emotion in investing, I would say those arenas, emotion is somewhat few and far between. It's all just numbers and data-driven decisions. Whereas even though people like to say, on the investing side of real estate that there's, not emotions driving decisions, I can't tell you how many deals I've gotten done, like you said, pressing palms, sitting belly to belly with the seller, and the deal got done not always because I had the best or the strongest offer, but because they liked me or I thought that I was going to do right by their investment and carry forward all of the hard work that they had put into it. Or you just never know, right? You can't assume that it's just a numbers driven decision. Of course, yes, that ties into the decision in a big way. But to your point, depending on asset class, seller situation, the market, so many different variables, it could be partly an emotional decision. And oftentimes that gets the deal done. Now, what are some of the common misconceptions or myths around mobile home parks, and why you have become so bullish and focused on this asset class in commercial real estate?
Yeah, the first is just the stigma around mobile home parks. People hear it, they think trailer park, right? Which certainly there's plenty of those out there. But there's 40 to 50,000 of these things, depending on who you ask. And maybe 10,000 of those are viable candidates for a purchase or for an investment if you want to get something of size and higher quality. And so, yeah, there are places that you wouldn't want to drive through at night, right? Those I think of as trailer parks. And then what we're really focused on is the affordable housing where it's respectable, it's delivering value to the tenants. And if you just kind of zoom out and think about what a crazy affordable housing crisis we have in this country for people that are making less than $70,000 a year, it's unlimited demand. And so it's a high need product. Really, if a town would let us develop, right, we would have unlimited. Have people lining up in California if they would let us develop here.
Yeah.
Of course they won't. But it's one of these things where it's the last stop on the housing train, right? There is no other cheaper option for people once you get past a mobile home park. And so I think the homes are getting nicer and nicer. They're built to stick-built standards at this point. And so it's a viable product. We sold a park to Sun Communities that in Texas 3 years ago that we actually were able to get developed, which is Texas is a rare state where you can actually get development done these days. But you drive through that community and you feel like you're in a subdivision, and you have plenty of young families that this is going to be their only path to home ownership anytime soon. Mm-hmm. And then that will be a stepping point for them to go buy their step-built home in 5 to 7 years after they've saved up some money. So they get a yard, they get a driveway. They don't have to be in an apartment complex with people on all sides of them, with no yard for their kids to play in. So when done right, it's a great thing for the tenants and also, of course, the investors.
Yeah. Yeah. And the community impact, there's obviously, like you said, a never-ending demand, especially in the affordable housing space. And maybe you could break down kind of, obviously, commercial real estate, when you talk about a category, oftentimes there's many different subcategories underneath that of asset classes, right? You kind of mentioned like you got your trailer parks, and then you've got, mobile home parks, and obviously those range in scale and density and operational capacity. Like how do you break down the different assets or sub-assets underneath let's call it a mobile home park or affordable housing type of product?
There's really, the star system is what we use to rate these things. So it's 5 stars. A 1 is a trailer park. A 5 is a retirement community with pickleball courts and bocce ball and tennis and maybe a little mini golf course in Florida on the water. So that's the two sides of the spectrum. We tend to play in the middle to nicer, right? So 3 and up. And I think you get the most bang for your buck if you're able to move a park up a level, right? Up a star. So if you maybe you want to buy a park that you're kind of close to and you want to do hands-on, and it's maybe a smaller park, so you want to just take your capital and really improve this thing, maybe you're playing at a 2. But a 3 oftentimes is pretty sizable. It's 50, 70 pads plus. We love 100 pad parks. It's kind of the sweet spot for us. And if you're driving through and you feel like, oh, this is a nice community where you could see grandma moving to someday if she didn't have any capital to afford a home or a retirement community, then that's kind of that's a 3-star park. It's for affordable. It's for working class families. It's for retirees as a mechanism to prolong their retirement. right? If they sell their stick-built home, they can buy a mobile home outright and not have any housing costs for the next 20, 30 years. So that's kind of how I think of the scale. And really what you want to do is come in with capital, come in with professional operations and improve the quality of it. And that way, when you are increasing lot rent, because the lot rents are way too low at most of these properties to kind of keep up with inflation, keep up with the maintenance of the property, then at least the tenants see that you care about the property and you're investing in it as well. I really do not like the boot camp mentality that some people teach, like these are cash cows, which they generate a lot of cash, but the best part of this industry is to be able to increase the rent reliably over a very long time and investing back in them to justify those increases.
Yeah, absolutely. Now, this asset class has obviously garnered the attention of institutional capital and made it a much more competitive space. How are you guys navigating that terrain? For somebody that's interested in looking at mobile home parks, do they got to start at the one-star trailer park to even be able to break in and compete? Or what's the overall landscape looking like right now?
Yeah, the way we solve that is by partnerships. So I am very big, kind of learning the lessons of not trying to do this and manage a portfolio from 2,000 miles away. I want to have partners that are very good in specific regions. And so because it's harder to find these deals today, right? When you broaden out the partners that you're willing to work with, like we get to see a lot more deal flow. So we invested in 5 parks of the last 4 months or so. And I didn't see none of those parks came across my desk from a marketing standpoint. Like if we didn't have the relationships we do with our operators, I never would have seen those parks. And I have a pretty good relationship with a lot of brokers because this is very much like we talked about, getting in front of pops somehow. That's at a local real estate, club event. That is through direct mailing, not just one letter, but like pounding these people year after year and just being very patient. That is, driving parks and asking to speak with managers. And then all of a sudden, oh yeah, the owner's coming by in the afternoon. Why don't you hang around and grab lunch with them? That's happened many times before. So it's really hand-to-hand combat to kind of find these things off market. And you could also find them through pocket listings with brokers by just making it very clear. And that's how I really started, was getting to know the kind of below the radar brokers that specialize in this space. And you'll be surprised at, the deals that they'll show you if you are very specific on what you're looking for. And so that's how I try to find deals. Like just going to LoopNet and trying to find these things on market is almost a fool's errand in our space.
Yeah. I mean, pretty much most asset classes nowadays going to Crexy, LoopNet, CoStar, you're late to the party, right? Because if the broker took it out to their list and they didn't double end it, well, then they're taking it out to everybody else, and most likely it's not as great of a deal as most would hope for. But let's say you find an opportunity that is something that initially intrigues you. Walk us through maybe how you're underwriting and analyzing a mobile home park deal. What are some of the metrics you guys look for? What are your assumptions, or how do you model it? What are some of the red flags that you're like, all right, we're done, non-negotiable?
Yeah. So really, I don't care about cap rate. Most of the time, the current owner, because they've owned it for so long, right? They have no more depreciation. And so they have a big tax exposure. And so they find all kinds of ways to throw in crazy expenses into the P&L, right? Like they're paying for everybody's car and their family. They're all on the health plan, yet nobody's working at the property. And typically the lot rents are way too low. So it's not going to underwrite to a reasonable cap rate. It's really that year 1 cap rate that I care about. And more importantly, year 3. So I want to get us to a 7, cap rate typically for a nice park in a good market. And we're on that 3-year mark. And therefore I know it's just going to be generating a lot of cash for the foreseeable future. And we're trying to hold these things long-term. Like I don't like the idea of buying something that it's really hard to find in the first place, bonus depreciating the thing, and then selling it within 2 to 3 years, right? Because once you find something that has this unique asset, this permit to be a mobile home park, and that generates a lot of cash flow, why would you ever want to sell it? Right.
Yep.
My preferred approach is to refinance, get all the cash out, have no more risk yet in the deal, and cash flow forever. But the red flags that we're looking for are really utility based. If it's a sewer treatment plant, right, that's no good on a 100-pad park. You could do it on a 250-pad park if it was in a good market, because then it's a $20 million deal, and you could kind of afford to do $1 million capital project someday if the thing fails. Lagoon, hard stop, right? So like anything that's like super gross on the sewer side is a hard pass. Septic we will do, especially if you have some space, right? Because you can move around septic systems. If one fails, it's not that big of a deal. But city water, city sewer is certainly preferable, but not deal killers if you have septic. Issues with, the city where they're constantly like giving violations, and, you look at those things and it's pretty clear the city wants this park out of there.
Yeah.
Right. Unless you come in with a very clear plan of ways to improve the park, and because you could be a godsend, which is oftentimes the case, right? If something's not operating really well and the owner is kind of ignoring it because they're out of state, oftentimes you come in with capital and real professional operations, and the city, you're their best friend.
Yeah.
So that's one. I mean, there's not a ton of red flags other than, if the seller is lying about cash flow. Oftentimes you get like a box of receipts, right? It's not like you're going to get this war room of due diligence files that's going to be just polished. So really the hard part is kind of getting comfortable enough to know what due diligence items are deal killers, and what can you actually roll the dice a little bit on, because you've just seen so much and that, okay, well, look, all these tenants are, they've invested in these homes, they own the homes outright. If I come in and I'm actually enforcing evictions, like they're going to true up. We rarely ever. So somebody doesn't leave in this industry because of a lot rent increase letter or enforcing collections, right? They leave because the park's being not maintained. So there are certain things that look like red flags, but the more you get, you understand this space, that you've got a good asset, good bones. As long as you come in with resources and professional operations, you're going to be able to turn it around.
Yeah, I was going to say to that point is maybe to flip it on its head. When you're looking at or underwriting a deal, what do you get excited about seeing that you can capture the value or the upside in that oftentimes maybe others miss?
Yeah. Ancillary income items is great. Like oftentimes there'll be a whole like separate parcel that comes with it that the park is permitted for more pads, and you can actually just come in and spend the money to expand the park. That's the dream. Oftentimes you'll have like a storage area that they're not using that you could turn into RV storage. You could build or even move in the self-storage pods for the tenants. Little things like that. Oftentimes the positioning of the lots is kind of haphazard, and you could actually move some homes around, or maybe there's a section of long-term RVs in a park, like Oregon, Washington, for whatever reason, have this where there'll just be a lot of long-term RVs that, the guys are there 18 months because they're there on a job. It's still a great tenant, but you can reposition that section of the park and actually get more RV lots, which, aren't as regulated by the permit for the property. Obviously, if things, if it's 50% below lot rents of the other parks, that's a huge, win.
Yep.
We see that all the time. If home prices in the area are like, 300, 500,000 and the lot rent is 300, 400, we're like, well, what would be the alternative here? That means apartment rents are probably 2,000 for a 3-bedroom. Well, the lot rent should be $1,000. If you just kind of think about what are their other options, what is the competition doing? And so you don't want to get there, overnight, but gradually that's your end state. Your end state's going to be that $1,000 lot rent in 10 years.
Yeah.
And so that's what I get excited about, is just being able to kind of move things that aren't dependent on cap rate compression.
Yeah.
I think we're no longer in that world. I don't think anybody can count on that anymore. So you have to have operational alpha, in this space, and too many people are tourists that think they're going to come in, buy something, do it from 2,000 miles away, and not reinvest in the park, and then sell it for a lower cap rate in the future. And that's just not where we're at anymore, I don't think.
Yeah, yeah, totally agree. Now, talking about how you are kind of structuring these deals, right? And real fast, what are you, when you're underwriting, are you solving for a cash on cash and IRR metric?
Yeah.
What are you backing into when it comes to how you're kind of modeling your deals?
Yeah. So I really think about risk adjusted returns, which, everybody says, but it's hard to conceptualize what that means. And maybe a better way to think about it for some people is just like a hassle adjusted return,
Mm.
right? Because I know if, like, for example, we're hopefully going to close on a deal in Omaha, that's really like right in the center of the town. It's been 100% occupied for 30 years, right? And it's really just kind of, do things around the edges, increase lot rent, repave the park. It's a very low risk execution type of play.
Okay.
Like, I'm perfectly fine getting a low teens return there. This one happens to underwrite to a 15 IRR. Um, and, but that on a hassle adjusted basis is more like a 20 for me.
Yeah.
Just because I know that, look, there's very little risk of demand. There's going to be unlimited demand for this location. It's been occupied forever. We don't have to do some hairy turnaround. We don't have to do any infill to increase occupancy. So that's kind of how I think about it. Like, if it's in a more rural area that's maybe 45 minutes outside of a major MSA, and there's some park-owned homes where the tenant actually, doesn't own a few of the homes, right? The park owns them, and the utilities are kind of rough, right? Then that's a hairier deal. I got to get a 20,
Yeah.
right, just to make it comparable to that 15.
Yeah.
That we talked about. So that's how I tend to think about them. Yeah, sure, I will do plenty of 12, 13s if I think we can hold that thing for 20 years, right? Because I'm really focused on, holding these things long term, as we talked about. I just think it's the best deal in the game if you can depreciate these things and then refinance them 3 to 5 years later and let them compound cash flow. And if you think about it, a 12, 13 doesn't sound amazing versus a 20, right? But we talked about the hassle adjusted return. And also, if you think you can really achieve that 12, 13 over 20, 30 years, that is an insane compounded return.
Yeah, right.
Yeah, from an evergreen standpoint. So usually the 20 IRRs are more like, 5-year holds, right, until you get things stabilized. But things that you think you can hold forever, like, you should really, you should lighten your expectations on total return.
So in order to achieve those returns, what does kind of your capital stack look like? And how are you structuring that, presenting that to your LP capital, or how are you guys just putting your capital stack together? What does that look like?
Yeah. Well, right now it's actually a weird time because, we're having a hard time pushing leverage above 50% for parks right now.
And why is that? Just so people that aren't modeling and understand your perspective on that, why?
It's a function of debt service coverage ratio. So the lender, there's not enough on the old lot rents, right, that are way below market, and on inflated expenses because Pops has owned it forever and it's not caring about, professionally managing the P&L on the expense side, and is also trying to shelter income.
Yep.
Right. Then it's hard for the lender to be like, oh, looking at trailing 12 months, it's hard for the lender to say, oh, we can lend X amount because we know the income's there. I know the income will be there, in year 2, year 1, once we can, change operations, but they have a harder time. So right now is really a refinance game, right? The idea is figure out a way, and sometimes we just do that through equity, where we're just going to over equitize a deal with 50% equity, which obviously is a governor on returns, but fine. Sometimes we'll add a pref layer. And that might be, through another group that we've worked with in the past. Sometimes one of our operators will bring the pref equity, which I kind of, as long as the current pay is flexible, right? So pref just means it has priority on the liquidation. So once you go to sell the property, that pref sleeve is going to get paid out first before the common equity. But I just kind of think of it as debt almost, right? It's just getting us to 75% leverage.
Right.
So you got to be more creative today, which I love, right? Because that means that it is a challenging buyer's market, which tends to mean you're going to get, or it's a challenging market just for the seller and for the buyer. So it's just a challenging market. That tends to be a great time to put money to work.
Yeah.
Right. It's a tougher time to raise money for some people. So you don't have as many syndicators in the space that, last year they were a dentist. This year they're a mobile home park operator, which is fine. It's great. But that became problematic, not so much in our space, but really in apartment buildings.
Yeah.
It became problematic, right?
Yeah.
Guys that were not used to, doing deals, taking floating rate debt, over leveraging things at peak rents, peak market, got a lot of people in trouble. So there's a little bit of that in our space, but floating rate debt wasn't that common. And so, I think you just got to be more creative with seller financing, pref equity, or over equitizing a deal and just trying to get to the refinance sooner.
Yeah. Yeah. I always tell people right now is one of my favorite markets, even though it feels stale to a lot of people and you got sellers wanting this, and because of, interest rates and economic headwinds, people, buyers want down here and there's this big gap, right? But there's still motivation in the market. You just got to find who and where it is. And I call it the season of seller finance, because if you can get as creative in a deal, and this is why I love commercial real estate, you can get as creative as the parties at the table are willing to get, right?
Totally.
And you can really architect and make a win-win in a lot of deals that if you had to just go the vanilla traditional, route, it doesn't make sense. It doesn't pencil. But if you can get creative minds that are willing to think outside the box and still find a way to make it work, there's a lot of different ways you can structure deals and still achieve the goals that most people are looking to. Hence kind of what you're talking about, right? Is in these challenging times, doesn't mean it's easier, but at the same time, those opportunities are out there and they can be even more fruitful than if, you just have the normal run of the mill opportunity that you're pursuing the normal way versus the creative way.
Yeah, it's a safer time to put money to work if you're kind of doing it in a thoughtful way and you're structuring these things versus, hey, I'm one of 30 bidders and they're just going to go with the highest number. And, oh, yeah, I won. But wait a minute, well, I just paid the most, right? So we're not in that world. At least right now. I mean, who knows, when interest rates decrease. I'm just assuming they never decrease, right? I just want to build our business plan to where we just assume we got to keep driving returns through operations and creativity.
Yeah, I love that you brought that up, right? Because I think that's, to your point, what happened in multifamily and a lot of the distress that one is happening right now, too, is coming down the pipe is these, individuals that were either raising capital or acting as GPs or sponsoring on deals. And they were, modeling assumptions in that were really not risk adjusted at all. And if anything, were way too rosy and blue sky, optimism. And therefore, that's where we're seeing a lot of people, run into challenges. So real fast, from your perspective, what are some of the ways to mitigate risk to ensure that you win, your investors win when you're modeling these deals, and kind of the discipline and the approach that you take and would suggest other, investors who want to win for the long term approach a deal?
Yeah. I mean, it's tough just because I don't think you can ever remove risk entirely, right? So, thankfully, in our space, I just think we picked a good sector because supply is constrained and demand is through the roof. So structurally, I've never seen lot rents decrease. I've literally never seen a park that I've looked to purchase where 1 year the lot rents went down 20%. You see that all the time in other asset classes. So I've tried to solve a lot of that problem by just picking an asset class with tailwinds and the structural advantage that we're talking about for affordable housing. But for a specific deal, don't over leverage, right? Unless you're strategically over leveraging. Like I've seen deals where you can get 85% seller financing and, because the income stream is so reliable, you might decide, okay, that's one of 10 parks that I'm going to invest in. And it's maybe 30% likelihood it goes to zero. But the upside is a 7x. So maybe you sprinkle one of those in a portfolio, but you would do that with your own capital, right? Or with your buddy's capital when you told them the full risk.
Yeah.
If you're going to just take random, people you're talking to on the internet type of capital, then you got to make it really conservative. Because I don't think most retail investors understand the risks they're taking in an illiquid asset class that isn't a cyclical business, right?
Yeah.
When it's capital intensive, our industry is very dependent on interest rates, of course, right? And debt. So you try not to over leverage if you're syndicating a deal. You want to make sure that hopefully you're buying something off market. So just structurally, you're not getting the competitive juices where you've overpaid versus 30 other people. Contingency plan, capital reserves. That's a big one, right? Like most retail investors, even though they should be thinking that they could get a capital call in an individual deal, they just don't think this way. Our subset of investors, we've never had a capital call, but we certainly conditioned them to that could happen, right?
Yeah.
And it's probably the best thing for the asset. There's plenty of multifamily guys that are doing capital calls just to get a rate cap today or try to save a deal that might be drowning. But if it's more just a one-time thing that popped up, or even better, if it's an opportunistic thing, hey, look, we actually ended up getting a permit to expand the park, right? That's a good capital call. But if your investor base doesn't want that, make it optional, right? But make sure you have enough capital resources to add to a property, because that's really a weapon.
Yeah.
Or to not only save the deal, but to drive better returns. I see too many people they barely get the money across the finish line to close the deal, right? And there's nothing left at the property level to withstand any surprises. There's all kinds of surprises.
Speak to that for a quick second. Do you have a rule of thumb? How do you approach that? Or for somebody that's going, okay, yeah, I'm cutting it a little too thin here. What should people be thinking about and doing when it comes to, given the proper capital backstop that's necessary to execute on the plan and actualize the pro forma numbers in real life?
Yeah, I wish it was more scientific. I don't have we do 10% clockwork every time or 15. It's more based on the risk and the age of the infrastructure. But generally that feels pretty good. 10% feels pretty good. We can withstand a lot of things with the cash flow in the bank. You don't want to see a 5-figure amount. You want to see okay, hey, look, there's 50 grand, there's 100 grand in the bank account. You can withstand a lot of surprises on a 100-pad park with 100 grand in the bank.
And real quick, you mentioned 100-pad parks kind of being your sweet spot. I'm assuming economies of scale and the density, and
you can afford a good manager at that point.
Okay, I was going to say operational efficiencies, arbitrage on certain aspects of the park. So what would you say to that answer? Is why 100-pad parks? Why are those the sweet spot?
In addition to that, right, because I learned the hard way. It's if you're trying to pay somebody, if it's a 30-pad park and you can only afford to pay them 20 grand, well, they're not going to get any quality for talent. They're not going to care, right? And so you want to be able to afford a staff, at least 1 to 2 people that is overseeing your asset. Ideally, 2, you want some sort of maintenance person, and then the property manager that's dealing with the tenants and collections and the miscellaneous items. The harder part, it's not to say I won't do a 300-pad park. It's just that then you're getting into the more efficient side of our world, where there would be 5 to 10 private equity groups, or even the REITs. There's 2 large REITs in our space, Sun Communities and ELS. Technically, there's a third, UMH, that's pretty sizable, but they're mostly in the Northeast. And once you get to that level, then it's just going to be harder to find something that looks like an 18 IRR or even 15 IRR, right? Sun Communities' cost of capital is their dividend, right? Really, they only need to make a 5 to 7% return near term, because it still moves the needle for them.
Yeah.
So that tends to be the sweet spot I think in not only you can drive more cash flow, absolute dollars, because it's probably going to be a $8 to $12 million park, depending on where it's at. You can afford better staff, and oftentimes it's a beachhead, right? If you're entering a new market, you want a 100 pad park, and then you want to add, you get to 300, 500 pads over time. In that area, you start to get some benefits of scale. Your employees can help out at other parks. When you fly out there, right? You can visit multiple assets. And like I said, the 30 pad park, it's great for a first time investment, or it's great for a side investment if you have another job, or if you're local to that property, because you can still make a lot of money, great return. But even a 30 IRR over 5 years, while awesome from a return standpoint, that's not a lot of money.
Yeah.
When you're bringing in investors and you have a team to feed. So that's kind of why.
That makes sense. Now, as you're raising capital, I'm assuming your capital needs have grown as your career, your parks, your portfolio has grown. What does that journey look like for you from when you were raising capital for maybe the first 1 or 2 deals to the evolution of, closing big deals with big price tags and needing big equity or, debt checks to be able to get those across the finish line?
Yeah, well, there's different paths you could take. Like I could have swung bigger and just gone the private equity backing route. I just didn't want to become an employee for a very large firm.
Yep.
So that is a fairly natural route, though, for people that get into space, where they'll kind of start with the 30, 50, 100 pad parks. They start building up a team, and then they decide, hey, well, I've run out of my network's capital, and instead of maybe trying to go broader with accredited investors, I'm going to go make a partnership with Fortress or Blackstone or Carlyle, who are all getting into the space. And so that is one path. You're going to earn a much lower promote, but you will have unlimited capital, right? If you are able to find good deals. So I don't knock that path at all. That is a great and tried and true way to make a lot of wealth in this industry, if that's what you want your life to look like, right? Your reporting is going to have to be a lot more professional. You're going to have to answer emails very quickly. You're going to have to jump on flights for meetings with the private equity team, the asset management team. If you want to kind of just grow this more organically, I see a lot of people do that over time, where they do like 1 to 2 deals a year. I've seen some people build amazing portfolios that way. And just they kind of slowly grow out of the day-to-day operations and hire better and better people over time. And oftentimes that's just with passing the hat around the country club or their personal networks. And then, there's the middle ground of building out a team and portfolio and having more deal flow, and then going to the accredited investor, network. It's a snowball, right? It's like, once you start performing, you return capital. The next deal gets a little bit easier. The next deal gets a little bit easier. And you start off, it was impossible to raise, the first 400,000 for the first deal. And then it gets easier to raise 15 grand for a little fun. So, it's just compounding. Everything in life is compounding, and this is no different.
Yeah. Talk a little bit about, I know people, they know that these things can be lucrative, but sometimes I'm always so excited when I hear somebody's, biggest win or success story in their deal, because you realize that the time, the energy, and the skills that went into it, for most people to have to put in the time, energy, and skills to get anywhere close to that type of return or payday, it's hard to beat or find anywhere else outside of commercial real estate that you can do a lot of these things and monetize your skills and relationships the way you can. So maybe break down what your best, biggest, most exciting or fun opportunity has been in your portfolio or over your career. Yeah. And how you felt like you were able to capitalize and bring that to fruition.
Yeah. I'll give 2 examples. One was during COVID, I sold actually my portfolio. And because I couldn't make sense of the metrics, the returns that some of these deals were underwriting to, and we were getting great offers. And my partnership, we decided that we wanted to go our separate ways. And so we sold the portfolio in 2020. And the timing of that was not great it was good in retrospect from a pricing standpoint. Like, sure, we top ticked the market in 2021, which was great. It was very challenging to get it across the finish line, though, because we had 22 parks, and that was like 15 different transactions. We didn't sell it as a portfolio. So because nobody was looking at portfolios, it was a tough time to get people's attention and focus because their teams were remote.
Mm-hmm.
So that was weird because it was like the whole year I felt like I was herding cats because I'm sure you've sold stuff. It's kind of like, you're just getting people and ducks in a row to get things over the finish line. You get deal merge, right? Oh yeah, I forgot. We're talking to a different buyer for this deal. Sorry. And so that was a year of chaos. But when we finally sent the last distribution to the investors and we're in the promote and big win for us, that was super rewarding because of how much hard work that went into.
Yeah.
Now on the easier side of the spectrum was just a deal that it was a 500 pad deal that we bought for $10 million. So the price per pad was pennies,
Wow.
compared to what it would go for today. And it was an off-market deal. It fell out of contract. When I say off-market, it was a pocket listing. So the broker picked a buyer. The buyer didn't execute. Now, these are kind of my favorite deals because the broker now is in a tough spot. The broker's like, okay, if I award this deal, if I recommend a different group and they don't follow through and close, the seller's gone. They're not going to give me a third bite at the apple.
Yep.
Right? So this is a weapon in real estate, is when you can be known as the group that closes. So then we got the call, hey, can you, sweetheart deal, like, here are the numbers of like, yes. And I sent the purchase contract that day. I gave up on every red line the guy wanted back. I said, fine, whatever, just sign, please. Signed, closed the deal. And then within 2 years, we sold it for 21 million or 20 million. And it was just like the easiest deal. We basically just passed out lot rent increases and tried to keep the wheels on because we didn't know the market as well. And it was just, it was cake. And we barely even increased the lot rent. So we didn't lose any tenants. You felt like we added value. We came in and, fixed the P&L so the banks could lend on it. Whereas before most banks couldn't lend on this asset. So we did very little things and got an amazing return in 2 years. So that was one that was just a lot of fun and a little easier that I think I would not have been able to do had I not seen, 100 deals prior to that.
Yeah, right. Just by being in the game, you get lucky sometimes, right?
Yeah, exactly.
So as we're kind of wrapping up here, I'm curious on what your overall thoughts and kind of outlook is on commercial real estate as a whole, as your particular asset class, pertains, and how that all ties into the, kind of grand vision of what you're building with your company.
Yeah. Well, I mean, we're obviously in a weird time for real estate. It's, as I touched on, I think it's an operational alpha universe that we're operating in.
How would you explain that to somebody that doesn't understand operation?
Sorry, alpha is just being able to drive above market returns, right? Beta is market. So if you invest in the S&P 500, you are accepting beta as your total return you're going to get. You just get what you get, right? Whereas alpha is driving higher returns than the market. Within real estate, to do that today, you're not, it's going to be harder to you're not going to get cap rate compression most likely. I don't predict interest rates, but I do know we have a very large deficit and debt problem. It's going to be very hard for the 10-year it's not going down to zero. I don't think anybody thinks it's going back to zero. So if it's not going back to zero, you're probably not going to get this cap rate compression. That is the low-hanging fruit in real estate that so many people benefited from over the last cycle. So operational alpha is buying something at or around market. You don't even have to get a giant deal, but you have so much more confidence in your ability to buy that deal because your team can drive the returns, can increase NOI through operational excellence and dialing every line item in the P&L to drive the NOI growth and get paid for that alpha, that growth above what just the market would pay you for. And then I'm trying to think through, I'm obsessed about what lasts a long time that we can compound cash flow slowly and predictably over time. I don't want to invest in anything that could be disrupted, right? I'm not going to pick the AI winner, right? Because who knows? So I do know that housing is pretty important. I do know affordable housing is unlikely to go away anytime soon as an asset class. It's easy for me to think that, 20 years from now, we might have a very difficult and challenging job market because AI has replaced a lot of jobs. So where are those people going to live? Where do they live right now? They need affordable housing right now. It's probably going to get worse.
Yep.
Right? Half the country has zero saved up for retirement. Medical advances probably mean people are going to last longer. So I want to do things that I know are Lindy, right? Are proven over time, that are likely to be the same for the next 50, 100 years. So I can eventually, give the assets to the kids and grandkids and keep compounding at a stepped up basis too, which is nice.
I was going to say, I mean, is generational wealth something that, when I see people like you, you've had an exit, you're crushing it, you're obviously living a very abundant life financially and, lifestyle wise. I'm always curious of what keeps people driving. Is generational wealth a driver for you? Or, based on your definition of wealth, what are you continuing to push your vision forward with in terms of inspiration?
Yeah, we're nowhere near generational wealth. Yeah, we're very comfortable. What drives me is really, it's fun. And what else am I going to do? I'm going to play golf all day. Like I go on golf tournaments and vacations, and by the day 3, I'm like, I hate golf, and I love golf, but there's only so much you can do.
Yeah,
and there's only so many European vacations you can go on, right? I mean, it starts to look similar. Oh, there's another amazing church with priceless paintings on the roof. Like, it does start to feel repetitive. How much time can I sit looking at this Hawaiian beach? Like, it's all great. Don't get me wrong. Like, I feel very grateful. But there's still a much bigger company that we can build, and we can generate, a fair amount of wealth, I think, for our investors, and do it in a way that I don't feel like I'm being ground down and exhausted and can't spend time with my family. Like, I've built our business now where, because we're partnering with operators, right, we can be selective, and I'm not getting the phone calls of the tenant that, hit the fire hydrant and the water thing is spiking.
Yeah, right.
So yeah, I try to design, what I'm doing today to be able to do it like Warren Buffett till I'm 95, right?
Yep.
So that's my plan. Who knows if I end up achieving it, but that's the idea.
Love it. Well, if somebody has a mobile home park deal they want to bring you, they want to get invested in one of your mobile home park deals, or maybe they just want to learn more about what you guys got going on, where's the best place for them to go?
Yeah, so the mobile home park side of our business, we do through Vintage Capital. So that's vintage-funds.com. You can shoot an email if you want to info@vintage-funds.com. And yeah, we're active. We're investing in a couple parks coming up here, a portfolio in North Carolina, Raleigh, that we're excited about. And so yeah, you can reach out and learn more.
Brad, it was an honor having you on the show, brother. We'll be sure to link up all of those emails, links, resources in the show description, show notes on Brad's episode. Thanks for coming on the show.
Thanks, Matt.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at @officialmattia, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.